Good morning, my name is Krzysztof Kwiecień. You're watching weekly XTB weekly trading webinar. So today we are going to talk about China, Federal Reserves, power curves, and more. So quite a lot is going on the markets, and lately a lot of this is related to China. Obviously, last week everyone was focused on Evergrande, the Chinese number 2 developer and the most indebted company in the country, and the question was, will they go bankrupt? But this is more than just Evergrande. So there is a lot of things going on in China right now, and the question is, will it eventually boil over, and will it eventually stop this mega bull market that we are watching in front of our eyes? So this is the question that we try to at least discuss today. But before we do that, let's start with what we typically do at the beginning of our webinar on Monday. So let's analyze the top news for Monday morning, and this is for sure German elections results. That these elections were yesterday. They ended what's called Merkel era in Germany, and it ended in a relatively poor fashion for her party, as they recorded the worst result ever. They lost narrowly to the SPD, but the other parties also were on the rise. So all in all, not a great result for CDU, CSU. However, the result that is not very conclusive. No single party, which is becoming a standard in Germany, is strong enough to form a government. Moreover, SPD has only CDU, CSU to choose as their coalition partner if they want two parties coalition. Otherwise, they will need two other parties, which means it would be at least three parties coalition, which is going to be challenging, because if you can imagine SPD with Greens, then obviously adding FDP to the mix would already be very complicated. So this what's called Grand Coalition is the main realistic scenario. However, from the market perspective, it's not going to be really that impactful, because these policies are not going to change fundamentally. So yeah, what's next? Markets return to the buy the dip scenario, something that we discussed last week, where I said, okay, maybe this Evergrande is a serious story, but the buy the dip tendency is so strong that markets will not even wait for a conclusion and will think, okay, this is another opportunity. And that's exactly what unfolded. And even though we don't know what's going to happen with Evergrande, markets already think, okay, this is story of the past, let's move on. This is a great market, let's be a part of it. So that's the story for today, but we still are going to pay a bit of attention to Evergrande, to China, and to the Fed latest slightly hawkish turn. More of the issues in China beyond Evergrande is power crisis, something that is happening now in Europe, especially in the UK. But this is not only a European story. The commodities are expensive, power demand is high, capacity is constrained, and this might be another issue that will have an impact on economic growth and inflation. So it's certainly something worth watching. This week is less dominated with major events and economic releases. We have those on Thursday and Friday, with PMI on China. I guess this is the main release this week, followed by September inflation in Europe and PC inflation on Friday in the US. All right, so let's start with Evergrande and with China. And the question is this over? I mean, markets already think like it's over. Everyone started buying again. However, the company is far from being in a safe place. They actually missed all the payments last week, and they only didn't default because they made an agreement with local creditors to avoid the official default. However, they missed the US dollar bonds coupon, and they triggered 30-day period, which could result in a default unless the coupon is being paid within the next it's like 26 days or something. remaining. And you can see here that there are a lot of these coupons in the months to come. So unless there is a direct help from the government or local governments, this is very likely that the company is going to default at some point, and it's quite likely, I would say it's 50-50, that the government might choose instead to prepare other parties for this scenario rather than bail the company out. So it's still certainly an issue, and it's not even as much about the direct losses as it is for indirect consequences of this potential event, because as you can see with these major financial institutions, the direct losses will not be that severe because the foreign debt is relatively limited. The bigger issue is obviously domestic thing, and everything is so much interconnected. Developers, construction companies, service companies, banks, local banks, national banks. So losses from the company, be it unpaid debt or unpaid coupons or unpaid work for companies, it may trigger a domino effect. And from that perspective, this is like Lehman Brothers in the US. However, the chain is of completely different nature, more economic, less financial. So the question is, will Beijing be able to actually contain it? And it might be so complex that something might go wrong there. So this is still something in play for sure. And with the magnitude of other things that affect the Chinese economy, I think there is certainly a room where something might eventually go wrong. So as you can recall, there was a push on the tech companies, paid education companies, casinos, cryptocurrencies. On Friday, they were actually outright banned in China, and exchanges that still serviced Chinese consumers are in a hurry to cut all the links. Otherwise, they're going to do something which is now a criminal activity in China. So with all of this and the latest power curbs, where it's being said that first of all, Beijing wants blue skies for Winter Olympics early next year, but more importantly, with commodity prices so high, they simply cannot afford this power consumption. So all of these things, they are putting brakes on the economy, and we already see this in the data. So it looks like it's going to get worse from here. I can hardly imagine any other scenario. And therefore, eventually, the markets may see that this is not a joke. Because right now, when you look at the market reaction to all of this, it's like okay, it doesn't matter. Okay, it's fine, right? We move on. But at some point, it's going to be, I guess, clear enough that the global economy is not doing as well as the official narrative says. All right, so before we move to the chart, let's also go through the Fed, because this is a part of this bigger story. The Fed last week, they didn't really make big moves. They said that the taper could happen soon, which market understood as November. The dots on the dot plot were a bit higher. However, it is important to remember that in the Fed, it's not an outright vote that decides interest rates. It's instead the FOMC president, and he can be dissented by the other members, but it's very, very rare. So it is really important where Jerome Powell sits here, and the blue, these blue dots is highlighted in yellow, is where I think he is. So if I'm right, it means that no interest rate increases are likely in the near term for the US. More importantly, however, the Fed said, and even Powell said this during conference, that it's possible that when they start this taper, so possibly next month or in November, they may end it in the middle of next year, which will be relatively quick tapering. You will see that because of the ECB and Bank of Japan, we will still have net net money printing, let's call it that way, which is not going to be very far from what we had on average during the past decade. However, as you might remember, we discussed this 2 weeks ago, we have this debt ceiling thing in the US, and regardless of how it's settled eventually, if it's with fireworks or not, there will be certainly political fireworks, but whether US loses Fitch AAA rating or so on and so forth, I don't think so, but there is slight chance. We discussed this 2 weeks ago again, so you can scroll back to this webinar. But what it means is that when this debt ceiling goes up eventually, which is bound to happen somewhere in October, the Treasury will have to really issue a lot of debt to build up cash reserves again, and obviously to finance the deficit. So bear in mind that this year these blue bars nearly made up for the financing from the Treasury. So the Fed actually sponsored more than 80% of the whole Treasury issuance. So obviously this meant that a lot of money was left on the market, because otherwise the Treasury would need to seek this money on the market. However, with the tapering, these blue bars are going to get smaller and smaller and eventually vanish, whereas the Treasury will have to keep issuing a lot of debt to finance the deficit and to replenish cash reserves. What it means that they will withdraw liquidity from the market, something that happened in 2018, which, by the way, was the worst decade, was year of last decade for all the asset classes. So I'm not saying that this factor alone will make it, but if you add slowing economy and liquidity withdrawal, then obviously it's a nasty mix that the markets ignore at this very stage. Obviously, there's the other scenario where the Fed suddenly say, look, we cannot withdraw the QE because we see the economy slowing down. This is a very likely scenario. I actually expect that at some point they will renew money printing, or they will just stop withdrawing it. So this is also something that we should be watching. So, but unless they do, and if they stick with the taper and the economy slows down, we can have something that could have very significant ramifications. So let's start with the US dollar, and as you can see on the euro dollar, there was hardly any strong reaction to the FOMC. However, if you look at the dollar index, and if you see what happened in 2018, where we had this mix of global economic slowdown and liquidity withdrawal, you could see that this was a year that was very positive for the dollar. So actually we are in a quite similar place on the chart right now, and I wouldn't really dismiss the possibility that this scenario unfolds again for the US dollar. Meanwhile, on the short term, looking at the short term for the equities, we are back to deep buying, what I said at the beginning of the presentation. Yes, we broke the lower limit of this very, very aggressive channel, but we are in a larger upwards trend, and we have a situation similar to March, where there was very tiny profit taking, slightly larger than the other ones, but still markets rebounded, and similarly we're looking like we are repeating this story. So unless investors, I think investors feel like they have this glass floor underneath them, and they just can move on, and we need something serious enough that investors really panic, because otherwise we are going to just have this deep buying. And I think this Evergrande situation shows this very, very clearly. This is potentially very, very hurtful scenario for the Chinese economy, especially given all the other carbs, and it may have very detrimental impact on the global economy. But because there is no direct impact, there are no direct ramifications that the markets see in front of their eyes, there is a tendency to ignore it very quickly and return to the deep buying scenario. So this is what we see right now, and also for the DAX, very swift return to buying, and also today strong reaction to the, I don't know to what actually, because these German election results are, I would say they're market neutral at best, because there is no strong coalition, which usually strong coalition is seen as good for markets. There is no such thing. So yeah, so it just reflects the tendency to, you know, return to deep buying, and for as long as there isn't any shock to investors, this is what we are going to see. All right, so next, what I want to highlight is obviously commodities, energy commodities. As you can see, Brent oil opening up with the gap today. These gap opens, they have a tendency to correct themselves. However, this trend is very strong, as you can see already here. The Delta variant correction on the oil market is long gone, and now we are back into the bull market scenario. And yes, and with the energy crisis looming, this has a potential to drive oil prices even higher. As you can see, there is some similarity to this period, where there was also such a correction, and as you can see, the markets back then, they just went up. You know, there was no, after these previous highs were beaten, there was no looking back, and actually prices kept storming up. So with all these issues that we have on the energy market right now, this looks like a quite a possible scenario. The other commodity that is being directly affected is natural gas. We have seen some volatility at the top. However, unless this crisis is resolved soon, we can blow higher here. As you can see, we are near to the important resistance lines, but historically we saw prices much higher than this, so I wouldn't say this is necessarily a ceiling. And the other commodity that is attracting a lot of attention is palladium, where prices tanked very hard because of this auto chip crisis. So the production obviously is being constrained not by the demand but by supply issues, and therefore demand for palladium, which is used for catalytic converters, has also declined. But you know, longer term investors may see, okay, this is temporary. For as long as demand is strong, this will just return in a due time. Okay, so let's move on to what's gonna happen this week. As I said, we have some releases towards the end of the week. I think most important is PMI from China. I really would pay a lot of attention to Chinese economy if you have a longer perspective, because the troubles may very well come from there. You know, with so many issues going on right now in China, I'm going to be surprised if we don't see a bigger slowdown in the Chinese economy. So this PMI is really important. There is a hope that we will see improvements after weak August, where COVID restrictions were in play. However, you know, with all the issues and now with the power curbs, we'll see for how long any improvement may last. Otherwise, inflation in Europe, in the US, however, I wouldn't expect these figures to really be that important. So we are headed for the market, which thinks that, you know, the Fed is over, that Evergrande is resolved. We are back in a happy place. We are for a week without any crucial releases and events, and very often such weeks bring unexpected events and volatility. So let's see. Please track our news section in the Xstation and Xstation mobile platforms, and we see each other next Monday. Have a great week.